For what has felt like a very long time, the US stock market has seemed like a rocket ship that only goes in one direction, up. But lately, some subtle cracks have started to appear. So let's dive into what's really going on and figure out if it's actually time to be concerned. Right, so this is the big question on everyone's mind, isn't it? After such a strong run, is the US stock market just hitting a little speed bump, or is something more significant changing? We're going to break down the key signals piece by piece. Okay, first things first. Before we get into the weeds, let's pull back and take a look at the big picture. You have to understand where we've been to make sense of where we might be going. And when you look at a chart of the Dow Jones, it tells a story of incredible long-term strength. I mean, the trend has been undeniably positive for a long time. So that's our baseline, a market that has shown a ton of resilience. But here's where things get interesting. When we zoom in and switch over to the tech-heavy Nasdaq 100, a different picture starts to emerge. And this is where we're seeing the first, potential warning sign. It's all about momentum. Now, to see this change, we need to use a really simple but powerful tool called the 50-day moving average. Just think of it as a way to smooth out all the day-to-day noise so we can see the market's real underlying trend. And the idea here is incredibly simple, but so important. When that line is sloping up, the trend has forward momentum, right? But when it starts to flatten out, or worse, begins to slope down, that's a sign the market is losing steam. It's like a car taking its foot off the gas pedal. And this is why this is a big deal right now. For about the last 10 months, the Nasdaq's 50-day moving average has pretty much been a one-way street, straight up. But now, for the first time in a long while, it's starting to roll over. And that's a change worth paying attention to. All right, so that's the first warning light flickering on the dashboard. So let's pop the hood and see what else is going on. Think of these next few indicators as more of those check engine lights. One might not be a huge deal, but when several start blinking at once, it's probably time to take a closer look. So the first thing we're going to check is something called market breadth. It sounds technical, but it's not. It just tells us how many stocks are actually participating in the market's rally. Is it a full team effort, or is it just a couple of superstars carrying the entire team? And this quote just hits the nail on the head. A healthy, sustainable rally is when lots of different stocks are moving up together. But when it's only a handful of huge companies doing all the work, that rally becomes really fragile. It's often a sign that a bull market is kind of running on fumes. Now, let's look at the actual data. This table shows the percentage of stocks that are trading above their short-term average. Just look, a couple of weeks ago, on February 10th, over 67% of stocks were participating. But by the 23rd, that number had dropped all the way to about 55%. That is a pretty big drop in a really short amount of time. So what's the takeaway here? Well, it means the rally is getting much, much narrower. And that makes the whole market more vulnerable. Because if those few star player stocks start to stumble, there's just not enough support from the rest of the team to hold things up. Okay, next up, let's check the market's anxiety level. We can do this by comparing two things. The VIX, which measures fear right now over the next 30 days, and the VIX3M, which measures fear a little further out. Usually, when things are calm, investors are a bit more worried about the distant future than about today. And if we look at the numbers from February 24th, this is exactly what we see. The VIX, our immediate fear gauge, is a little lower than the VIX3M. And that's actually a good sign. It tells us that while there are definitely some concerns bubbling up, the market isn't in a state of outright panic. At least, not yet. And of course, we can't completely ignore the wider economic environment. Two big things to keep on your radar are interest rates and the US dollar. Simply put, when interest rates rise, those high-growth tech stocks often look a bit less attractive. And a stronger dollar can act like a brake on the global economy. Both of these are potential headwinds for the market right now. So, we've got a trend that's showing signs of weakness and a rally that's getting narrower. The million-dollar question is, what do you do about it? Well, this last section is all about having a smart plan. And let's be clear, this is not about trying to predict the future. It's about having a process to respond to what's happening now. Let's go right back to our car analogy. When those warning lights start to flash on your dashboard, what does a smart driver do? They don't slam on the brakes and jump out of the car in a panic, but they also don't just ignore the lights and hope the problem goes away. They take sensible, proactive steps. So what does that look like for an investor? Well, what we really want to do is avoid the two extremes. On one side, you've got panic selling. That's an emotional, all-or-nothing reaction. On the other side, you just have blind hope, which is just wishful thinking. The sweet spot, the smart approach, is right there in the middle. Prudent planning based on the evidence in front of you. So here's a really simple 3-step framework. First, just acknowledge the signals. Don't ignore them. The data is telling us that something has changed. Second, think about scaling, not panic selling. Maybe that means trimming back some positions a little, not liquidating your entire portfolio. And finally, and this is so important, wait for confirmation. Before you decide to take on more risk, let the market prove to you that it's healthy again. Okay, let's wrap this all up with 3 key takeaways. First, the Nasdaq short-term trend is clearly losing momentum. Second, the rally is getting narrower as fewer stocks participate, and that makes it more fragile. And maybe the most important point of all, having a disciplined process to manage your risk is way more valuable than trying to guess what the market's going to do next. Look, at the end of the day, the market gives us signals, not certainties. These changes don't guarantee a crash is coming tomorrow, but they do tell us that the level of risk has changed. And that leaves us with the only question that really matters. Do you have a process to respond when it does? And just as a final note, please remember that this is all for informational purposes. It is not financial advice. You should always consult with a qualified professional before making any investment decisions.